Hey everyone, how are you? Chris Urso here with URS Capital Partners. Excited to take you through our Q4 update of our property performance. So for those of you that don't know us, we are a multifamily real estate investment firm based out of New York with a focus on the Southeast and certain parts of the Midwest. We've been doing this since 2009. I'm going to take you through a little bit about us, our portfolio for the quarter. Consistent, we've done this now the last 3 quarters. We thought it was important in this environment to kind of share what we're tracking, what we're seeing across our portfolio, especially a lot of headlines every which way in our space that are coming out on a pretty regular basis. So we like to share kind of what we're doing inside our portfolio and then also what we're seeing in the market overall in terms of opportunities. We're pretty excited for, kind of between now and the next 24 to 36 months potentially, what we're seeing out there and our abilities to go out and acquire some great assets here in the next 12 to 24 months plus. So we also handle all of our property management in-house through our property management division, which is URS Properties. So we are vertically integrated, so we have direct access and oversight across all the assets in our portfolio. We're ultra hands-on. So the purpose of this is kind of share what we're seeing in our limited portfolio. We have sold over the last, probably 3 years now. We've sold about a dozen deals, up to and including a property we just closed on the last week of January. So we actually sold a deal and bought a deal in the same week. First time we've done that in 15 years. But again, we've acquired 25 properties. We've developed or in the process of developing our fourth ground up deal, just over 1,000 units. So you can see there collectively, over $600 million worth of acquisition and development. So we've sold 22 of those assets strategically over the last, probably 5 to 6 years when we really started selling, 6 years or so. With the majority of those being sold in the last 3 years. So we saw the market kind of running ahead of us. We harvested a lot of gains out of our portfolio, skinnied it down to where we just have, our 4 ground up developments and 2 existing assets that were acquired in our portfolio. So we are kind of unit count wise smallest we've been probably in about 5-6 years now at this point. That was by design. Was really to be ready to take advantage of an opportunity or a dislocation that we're seeing in the market and reload our portfolio with some great assets for the long term. So across those deals sold, we've averaged a 35.6 IRR, a little over a 2.07 multiple on the equity with an average hold time of just about 39 months. So that's a little bit about us. This is some of our new developments and existing assets we just sold. Latitude Richmond Hill over here. And I'm going to move that there. And we'll jump in. So there we go. Perfect. So again, nothing fancy, nothing slick. This is basically was our portfolio as of Q4 of operating assets. Latitude and Richmond Hill, 192 units. Let's see if I can do this here. Let's see if this works. There we go. So you guys can follow me. Latitude at Richmond Hill, 192 units, Savannah, Georgia. So these are the metrics that we're looking at on a weekly basis, monthly basis, quarterly basis, obviously. We had 150 global leads come in for that property, and that's online, offline, emails, phone calls, opt-ins to a website, apartments.com, Zillow, etc. Those converted to 49 tours and 37 leases, so really strong for us here at LRH. We had a period in time where we had a bit of a lull in Q3, Q4. We saw a big dip in occupancy as a result of, you can see here, Q3 we closed out at 85.9. Q4 we closed out at 91.9. This property does serve a good bit of military, did serve a good bit of military. We've since sold the property, but we had it for about 4.5 years, and it was one of our really steady assets. And we had a couple of redeployments happen simultaneously through different divisions in the military. And there was a weird lull where we had to kind of wait for folks to recycle back in. And that property actually was sold north of 95% occupied when we actually closed on it end of January. So you can see strong in terms of our leads, tours, and conversions to leases. Crescent Place, massive amount of leads came in, resulted in 141 tours, 35 leases. You could see again occupancy ticked up here in the close of the fourth quarter. So overall, kind of the common theme was, to be honest, we had a better fourth quarter, I think, than we all anticipated, just given the holidays and seasonality. Crescent Place is a workforce property, went through a major renovation and reposition. We've had the property for only about 22 months as of today, and we've transitioned over the majority of the tenant base here. So we expect some volatility in that type of turnaround, where our average rents have increased almost $500 on average since the day we bought it to where the rents are today. So our focus really in Q4 was to drive occupancy, get control of our AR and collections, really work on cleaning up delinquency, because when you're pushing rents that hard, you might get a lot of renewals, but tenants can't sustain those types of increases, so it's expected. We've done that. You'll see we're going to continue to kind of tick downwards on our AR, and occupancy is continuing to climb there. We believe we're now kind of on the back side of our reposition, where we've transitioned through and recycled almost the entire property inside of 24 months. So very happy there. Latitude South Portland, up in Portland, Maine. This was a brand new development for those of you that aren't familiar. This was our first Opportunity Zone project that we did. We broke ground 2019. We've since refinanced the property beginning of 22. I want to say 21 or 22. It's been a minute now. So we are now in just straight up cash flowing. 230 leads came in, 60 tours, 14 leases, but the property is 97% occupied as of the close of the quarter. Prior quarter was 96.5%. Really just an underserved market. We built a great product there. It's been super well received. We're now at a point where we've returned 100% of the equity out of the deal through refinance proceeds and cash flow from operations at this point. So very proud of our first development there up in Portland, Maine. Exchange at Rock Hill, beautiful property, Rock Hill, South Carolina. So suburban Charlotte, basically 30 minutes south of Charlotte. 318 leads, 61 tours, 30 leases. Closed out occupancy about 85.4% versus 84.7%. So this is one that's definitely been a challenge, right? So definitely a victim of a lot of the new development that's gone on in and around Charlotte. We're really battling for this last 10% of occupancy right now. And I think you'll see we've turned the corner here shortly when we wrap up. We'll give you where each of these assets are today. Sorry about that. So what's happened there is we're getting good traffic, decent leasing velocity, but it's Rock Hill, it's not Charlotte, so velocity is going to be slower. We love the market for long term. This is an Opportunity Zone project as well. It's probably the nicest property in Rock Hill. It's gorgeous. We took an entire city block, downtown Main Street, Rock Hill, scraped it, redeveloped the whole thing into a beautiful 229 unit, 3-4 story, elevator served, tremendous amenity package, been really well received. But what's happened there, we've been in the lease up now for about 18 months, give or take, and we're catching the backside of expiration. So no matter how good our team is, it's a higher end demographic that's in the property. So you're going to lose people to buying a home or job relocations, etc. So we're getting caught on the back end battling expirations as we're trying to finish off our lease up. But we are at a point where we've made the decision. Our rents were materially higher than we underwrote given the run up in rents over the last 2 years. So we've cut some pricing here in end of fourth quarter leading into Q1. We're seeing some good traffic, some good momentum here. We expect to close out Q1 over 90% occupied, which is a big milestone for any lease up, and then be on our path to 95%. So again, Farmhouse Apartments, now Murfreesboro, Tennessee. This started our lease up back in February of 2023. We had 396 leads, 79 tours, 39 leases. We closed out occupancy at 55.9%. So a big milestone. We broke the 50% barrier on every lease up. That's the first big one to go. And you can see prior quarter was 43.4%. Cobalt Row is student housing. So this is 750 beds across 240 townhomes and single-family detached cottages, 4-bedroom units. So, this is, for those of you that aren't familiar with student housing, it's we're in pre-leasing mode now for our 2024-25 school year. So we're 99% occupied for the 23-24 school year. We're now leasing for move-ins in August of 2024, which will cover the 24-25 school year. So 10 tours, 81 leases, again, a function of the student housing market. A lot of that stuff is either a combination of people that just know what they're getting. They don't necessarily need to tour as much as you would in traditional apartments. So again, 99% leased. It was 100% prior quarter, but this is we'll bounce between 99 and 100. So student housing, a little bit different of an animal, but we love this asset. Serves MTSU, Middle Tennessee State University. It's definitely the best-in-class product in the market. Little to no new competition will likely ever be able to come into the market due to lack of zoning and lack of sewer capacity. So we feel as the state of Tennessee continues to grow, MTSU is the number 2 state school behind UT. So as population growth continues in Tennessee, we expect to see continued healthy demand for MTSU students for the foreseeable future. It's just great real estate that we intend on keeping for a pretty long time. So next we'll look at rents. Again, Latitude Richmond Hill was kind of flat quarter over quarter. Our focus was on occupancy, which is really a driving force. So you could see here, this was as of the end of the year. Again, we had 32 move-ins for the quarter versus 30 the prior quarter, with an average increase of 3.5% on those move-ins, meaning average increase amongst prior lease on that same apartment. So, again, saw a little bit of increase here, $18 give or take on rents. Nothing too material. Crescent Place, we're seeing that upward trend as we continue to release apartments at today's rates on the transition here. Again, I'm going to focus on move-ins, 29 move-ins versus 21. Again, really healthy and kind of unexpected given seasonality from, October, November, December with Thanksgiving, Christmas, winter months, etc. Feel really good about that. Latitude South Portland, we're seeing steady incremental rent growth on renewals and new leases here. So 28 move-ins versus 35, 4.7% increase. So you're seeing a positive trend on new leasing here for the first 3 assets. Exchange at Rock Hill. Again, this is a function of us, shaving some rent a little bit. Not too big of a movement on our overall in-place rents. But we had 33 move-ins versus 52. So definitely slower quarter at Exchange versus some of our other properties. Again, you can't hide from supply, right? This is part of opportunity that we're looking at. There's a couple of drivers we're going to talk about at the end of the call about what we're seeing in the market. But we're long-term, we're well capitalized, and we're not panicking. We know it's a great asset. The resident reviews, the responses and satisfaction that we're getting from our current tenants is excellent. The market's running at 95% around us, so everybody is in an occupancy-focused operating strategy right now. So again, we're not necessarily in a position where we're looking to move the needle on rents. We've captured higher rents than we anticipated and underwrote, so all focus is on occupancy right now. Farmhouse apartments, again, a little bit of seasonality. Tennessee gets some snow here and there, an inch, and the world shuts down for a couple of days till things de-thaw. But you can see here, rents pretty much flat. We're not moving rents until we break, some meaningful numbers on occupancy. But 44 move-ins for the fourth quarter, really not too bad. Pretty happy. We obviously had a monster third quarter with 61 there. And, lastly is Cobalt Row. I'm going to put that up there. So Cobalt Row, again, most of our move-ins happen in August. So not to be unexpected. So the prior quarter, as you could see, had 387 move-ins because that was third quarter when we have move-in season in August. So, pretty healthy in terms of move-ins, pretty healthy in terms of rents, no material declines anywhere. We are using concessions at our lease-ups. I think it's important to note that, the competition is out there. So, you're running anywhere from 4 to 6 weeks of concessions is kind of commonplace. And that's upfront concessions. So on the first full month or first full 2 months, they'll get anywhere from 4 weeks to 6 weeks of free rent baked into their lease signing. And then from thereafter, it goes to market rent, on a monthly basis. So then we're focusing on renewals here. So across the board, we had 20 renewals in Latitude Richmond Hill, 23 move-outs. We saw an average increase on those renewals of 4.1%. Bad debt that we took this quarter versus last quarter was basically a function of 2 residents that were accumulating a large balance that we were finally able to take out. So again, nothing overly concerning. We actually sold the asset, as I mentioned earlier. And then we have Crescent Place, they've done a fantastic job through the reposition on being able to execute renewals. Our residents, the residents that could afford to stay want to stay. And I think it's evident in the numbers. We completed a $5 million renovation here within the first 14, 16 months of ownership. Full gut of the clubhouse into a brand new state-of-the-art gym, club room, new leasing office, all new pool furniture, dog parks, grilling stations, painted all the buildings, landscaping, signage, and an interior renovation program simultaneously. So we couldn't be happier on that front with the renewals here, seeing an average of 11.2% increase on renewals. Bad debt, $13,000 versus $15,000. That's ticking downward. That'll start to continually creep down. It's really not all that bad. The average rent on this property is about just shy of $1,500 a month. So really not too bad collectively, and that's a combination of maybe 3 to 4 units there, 3 to 4 residents, if that. So that's something that we'll continue to work through. It's basically a workforce plus community, so not out of line from a percentage basis on the gross potential rent. Latitude South Portland, 41 renewals, 26 move-outs, average increase of 6.7%. Closed out the quarter with no bad debt, so couldn't ask for much more there. Crushed it on their renewals. Exchange at Rock Hill, 16 renewals, 31 move-outs. Big part of the reason, if you look back here, occupancy-wise, that we were pretty much stuck in the mud, right? So we had 33 move-ins for the quarter, but we had 31 move-outs, right? So that was one of our heavier quarters of expirations. We've been super proactive coming into this year on our renewals, offering people flat renewals and some incentives to stay in place to get our occupancy where it needs to be. So 16 renewals, 31 move-outs, average increase on renewals, you could see 1%. No real bad debt concerns here. Farmhouse apartments, no renewals. We're not really bumping up on too many. We had 8 move-outs. Those were generally short-term leases, people that were relocating to the area we were aware of, that either did a 3, 6, or 9 month lease when they came into the area while they were waiting for their housing if they were buying a home or a home was under construction. So nothing alarming there on either the move-outs or the bad debt. Cobalt Row, this is kind of tricky. So the number of renewals, 297. This is for the 24-25 school year, and we're averaging about 6%. We think we're going to close out with about 10% rent growth on a per bed basis between 23-24 school year and 24-25 school year. And bad debt, not uncommon. We recapture a lot of this. post write-off. So once it goes into collections, it's a big line item that moves up and down. You can see we had nothing this quarter versus 15,000 last quarter, and some of this will be recaptured over time through collections. So then this is our NOI growth quarter over quarter. So you can see here Latitude Richmond Hill was down for the quarter. And that was really a function of our occupancy and getting that back on track. But if you look at it on a T12 basis, which is trailing 12 months versus the prior 12 months, our NOI is up 10% on that, net operating income. And that's going to start clawing its way back, both for Crescent Place. We took an occupancy hit for the fourth quarter versus third quarter. So we were down 8%. We're already seeing that number come back up. So I expect us to see movement back into this range of, north of 580 plus for the first quarter of 2024. Obviously, the NOI, has crushed it here from when we bought it, given the increase in rents of nearly $500 on average. Latitude South Portland, pretty steady earner through the winter months. We tend to be a little more expense heavy with things like snow plowing, etc., heat, common area heat. Really good NOI growth, though, year over year on this asset. So Exchange at Rock Hill, we're moving in the right direction from an NOI perspective. We're up about 20% quarter over quarter. This, obviously, trailing 12 over trailing 12 is up materially because this is now we're moving, occupancy continues to climb, right? And the same goes for Farmhouse Apartments. We're trending in the right direction, obviously, from a lease up perspective. Cobalt Row, you can see NOI this quarter was up pretty substantially because of the August move-ins at higher rents now hit for the last quarter of 2024. And you'll see this year over year number continue to grow as well, because now we have 3 more quarters of elevated rents for the remainder of the school year. So I hope that makes sense. And then this is something that I don't think enough people talk about, the amount of moving parts. And this is where we're beginning to see a lot of operators have challenges, right? So is on the work order side and the maintenance side of things. We'll have anywhere from 150, 300, 240, 265, 500 work orders come in at a property. And then we're tracking weekly to make sure that those work orders are getting closed out and our tenants are getting taken care of. And this kind of shows you, the maintenance scope of who's handling what and how it's being handled. So this is a huge part of operations and the blocking and tackling that goes on in our business that people don't really see or understand. It's our job as the managing member or general partner or sponsor of these investments to do this on behalf of our limited partners and investors, of course. But I think a lot of folks that aren't kind of in it in the day-to-day think, this is an asset class that you just kind of buy it, hand to a management company and wait once a month for your financials and your distribution. But it's a combination of all those things, from driving leads to tours, to how your team is responding on those tours, to convert to leases, to tracking your expenses, to managing your renewals, managing your expirations, managing occupancy, and then ultimately managing your maintenance and your customer service side is critical, right? The majority of tenants, if you ask them what they want a clean, safe place to live, and they want their issues fixed in a responsible amount of time, right? And good communication from their management team. So shout out to all of our maintenance guys, the guys and gals that are out there kind of in the field, making sure the sites are presentable, curb appeal stays intact, our amenities are clean, and our tenants are catered to in terms of their needs from an apartment level or property level. So critical to the overall success. But there's a lot of moving parts. I think this is something that most people don't realize, that we can get, 200 work orders on a brand new property. Now, obviously the varying degree of those work orders, depending on the age of the asset and quality, is going to be completely different. A work order on a Class A property could be, I have a light bulb out. People will call for. So versus, an active leak or a backup on an older property, that our guys have to respond to in a pretty quick fashion. So, I mean, this is one of the things that I think I'll touch on in a second, but where we're seeing opportunity is on the operation side. And there's owners that, it's more distressed owners than necessarily distressed assets, but the more distressed an owner gets, the more distressed an asset typically gets because they're not giving them the appropriate staff or budgets to maintain the assets. And those are some of the opportunities we're seeing today. But one of the things I just want to share here on all these assets is, kind of where we are as of last week. So Latitude Richmond Hill has since been sold. Crescent Place is now 99% leased. Latitude at South Portland, 98% leased. Exchange at Rock Hill is 93% leased. That's great to see. Farmhouse Apartments, 61% leased. And we are 51% leased for our 24-25 school year at Cobalt Row. So good start to the new year in terms of demand and leasing. We're hoping for a good spring leasing season. Typically starts around tax refund time, which is somewhere in, end of February through March for those early filings. And then we see that typically carry through, June, July, August in terms of our leasing season. So looking forward to see how all these numbers translate in Q1. So it's like there's conflicting themes going on, in multifamily, which we'll touch on in a second here. But, one of them is, I'm going to just do that because I don't like showing that. And this was more just a headline. So sorry about that. These are just some headlines that, are coming out by the day, and week related to our space. So this is what has us excited. This is what we've been preparing for, for the last several years, is this opportunity where there's dislocation in the market that we can step into. And where is the dislocation coming from? Why is it happening? There's a couple of factors. Interest rates have moved exponentially in a very short period of time. Short-term rates are up nearly 500%, if not more, since the lows of early 2021. So you're talking about in basically less than 3 years, rates have moved 500% on your short-term borrowing costs. That brings a tremendous amount of pain for those that have short-term floating rate debt. Even with rate caps, your cost of capital has likely doubled, even with a rate cap in place. Now your rate caps are expiring, and those rate caps are costing, multiples of what they cost 2 years ago to keep that in place. Not just that, the 10-year has been hovering around, as of late, 420, 430. That's up probably at least, I don't have it in front of me, but if I had to guess, at least 150 basis points in the last 2 years. And the 10 years typically not as volatile, and that's how we typically benchmark our longer term fixed rate financing, is based on the 5, 7, or 10-year rates. So we come from a place of, we've been tracking this very closely in the market. We're looking at loan maturities, we're talking to our brokers, we're talking to owners. We want to be active. We just bought our first deal coming in, during this cycle. It was a loan assumption. We acquired, what we think is going to be a great asset from a great group that we've known for a long time. And, they're just shifting in their business, not really going to be focused on multifamily for the long term. And it was a good opportunity for us to step in and take over operations in a market that we really liked, assume the existing debt at 4.8% for another 6.5 years. And we believe there's some meaningful operational upside that can be achieved while generating in-place cash flow. So, just some of the things that we're seeing out there, right? It's a convergence of rising rates very quickly, coupled with new supply peaking and deliveries peaking in 24 and 25 in most major markets. And then you also have operating expenses that have grown, in some instances, high double digits, 10, 15, 20, 30, 40% on the insurance side across most of our markets, and not counting any other sort of operating expense increases as a result of inflation for the last 2 years. So you have all of these things, you have softening it's not even demand softening, it's increasing supply that is creating a softening in occupancy and overall demand and rents, right? Because supply is now outpacing demand. But we believe this is a short-term dislocation, right? Because what we're seeing at the same time is a lot of new developments that were slated to start this year are not happening this year because of higher rates and more challenges to raise equity in this type of environment. So what we expect to see is this peak of supply. It's going to take 24, 25, and likely most of 26 to get to a normalized equilibrium again. But on the backside, we're expecting to see a shortage or drop off of new deliveries through 25, 26, 27, 28. So we think that there's going to be some outsized growth headed towards us in our sector if you can weather the storm for the next 2 years. So those that are kind of bumping up on maturities or don't have the appropriate reserves are going to be faced with some tough decisions. And not just that, it's a challenging operating environment, right? You have to do those things that I was talking about day in and day out to compete. The blocking and tackling is critical in this type of environment. And what we're seeing is a lot of operators that were inexperienced that came into this space in 2018, 19, or even later, and were accustomed to buying deals and selling them within 2 years, doing a little bit of quote unquote value add and being able to sell it at a great multiple on their equity because cap rates compressed because interest rates were basically at zero, meaning cap rates came all the way down, values went all the way up. Now it's an inverse situation where interest rates are up here and cap rates are forced to push upwards as a result of that. So bringing values down. So we're seeing guys wiping out equity down to zero. We're seeing deals say, hey, if you can hit the debt, we'll sell 25, 30% off prior sales, if not more in some instances. We're seeing, the ability to get to, 6.5 cap pretty clearly on deals that are having some operating challenges or being mismanaged. So what I touched on earlier were these deals where imagine if your cost of capital went from $100,000 a month when you acquired the deal 2 years ago. Now that same capital you have is costing you $200,000 a month, right? That's a very common scenario. So that's evaporating your bottom line. So no matter how good you are on the top line, to keep up with that type of rate increase and cost of capital is very, very difficult. That means you have to execute absolutely perfectly in every aspect of your operations. And what we're seeing is guys are operating in negative cash flow situations. They're not capitalized appropriately. So now they can't staff the property adequately. They can't market the property adequately. They can't maintain it adequately. So you see this downward effect on the property's performance because it's capital starved, where really the market around it is running at 93, 94% occupancy, but you might have an asset that's running at 82% occupancy because of the ownership challenges, not necessarily an asset issue. Then we're seeing deals that are not getting necessarily the capital attention that they need because of that same reason, right? Guys ran out of their CapEx budgets. They burned through their CapEx and now they don't have enough cash. They can't withdraw. They can't call any more capital because they need to replenish interest reserves or buy another rate cap. So there's a lot of driving forces that are out there that are creating what we believe is kind of a once every 15-year type of event in our space, and we want to be equipped to take advantage of it. So we're super excited for what's in store over the next 12 to 24 months. Our markets of focus continue to be North Carolina, South Carolina, Tennessee, Georgia, even parts of the Midwest. Cincinnati, Northern Kentucky is where we got our start. We love that market. We want to continue to look at new opportunities there to reestablish our presence there. We think it's a great, steady market. So we are on a path with a goal to acquire 2,000 to 3,000 units over the next 24 months. We've just knocked down our first 176 of that. And we've got some exciting things in the works to help us get there, and achieve our goals. And, we think we're all going to be extremely happy with anything that we buy over the next 24 months with the intent to hold for the next 5 to 7 or 10 years. We're going to be extremely happy. with those purchases based on what we're seeing in the market. We're seeing more deal flow than we've seen in a very, very long time. So as you can see here, these are just in our markets that are in the blue shade. There's $68 billion of debt that's maturing, over 3,000 properties between 24 and 25. And this is super exciting because this covers everything from new development to existing deals or deals owned by funds for a longer term or deals that were financed, just 2 years ago. There's going to be people forced to make decisions. And it doesn't mean that the assets are all in major distress. This means that there's a challenge in the capital structure. If somebody borrowed $25 million 2 years ago at 85% of cost, there's a very good chance we've underwritten almost every maturity across our markets. And we've seen time and time again that $25 million loan, the max refinance that it can get today is maybe $21 million or $22 million. So there's a shortfall there. So sellers are going to be faced with a decision: can they find capital to right size their loan, or are they going to be forced to sell the asset and move on and wipe out their equity down to a zero? And we're seeing that happen for the first time in probably over a decade at this point, where there's actually deals where people are taking losses versus what they acquired their asset for, just 2 years ago. In some instances, we're seeing deals that are trading, back to 2019 levels. So it's very exciting. This tells us there's opportunities coming. The numbers don't lie. And in our space, which is really kind of sub $75 million deal size with a sweet spot in the $30 to $50 million deal, we want to be as well prepared and equipped as possible to move quickly, to get the best possible pricing, and continue to get the early looks that we get from the relationships that we've built over the last 15 years. So I touched on the profile of sellers here. It's kind of all of these common themes, and this covers value add, core plus, and lease ups. I think one thing that we've done a really good job at over the years is not being, kind of a one-trick pony. We're very disciplined. We'll look at hundreds of deals to get to those 2, 3, or 4 deals that we want to buy in any 12 to 24 month window. And we'll go up and down the food chain where there's value, where there's opportunity to create value quickly. That's one of the things that we've done really well, is being able to identify dislocation, not just that, now there's a market dislocation, but we've built our business looking at assets where there's a property level dislocation or an ownership dislocation, something that we can go in and sink our teeth into. And now you add the macro dislocation to it. So it's basically like we're able to execute what we've done really well over the last 15 years across 29 deals. We're now able to do that in an environment where there's macro headwinds helping us get the best possible deals that we can find in the market. So if that makes sense, it's like we've been a deal dislocation focused company for 15 years. Now there's a market dislocation there that kind of only adds to our ability to outperform. We've done 35% IRR across the 22 deals we've sold, operating through, various markets over the last 15 years. And now we have a situation where all of these things are happening at one time and creating this dislocation in our asset class that we believe is short term. And fundamentally, over the next 10, 15, 20, 30 years plus, as it has been for the last 50 years, multifamily has proven to be the greatest asset class when it comes to commercial real estate. It provides the inherent need of survival and shelter. At the end of the day, everyone will always need a place to live. Everyone doesn't need to go get their nails done or go to a restaurant or go to a hotel or have that self-storage locker. Everyone does need a place to live. And we think it's a very defensive asset class that, we have an opportunity in front of us to be able to buy really good assets at a great basis for the long term and reap the benefits of when the market turns back in terms of an equilibrium on supply and demand. We think we're going to be in a great place. So those of you that don't know us, feel free to reach out to us. You can email us at info@URS Capital Partners. Hope you enjoyed the update. I know it's a little bit longer, but we want to stay true. We're going to continue to do these quarterly updates all the way through. and give you all real visibility into an actual operating portfolio versus all these stats that are being thrown around every day in our space from one side or the other side. And thanks so much. If you have any questions, feel free to reach out to us, info@urscapitalpartners.com. Thank you.